Well, this is where the word depression comes in, and it confuses a lot of people because a lot of people who follow economics, whatever, they know that a recession with an R is two or more consecutive quarters of declining GDP. And most recessions are fairly short, so they are 2 quarters, some are three, some are longer, but 2 quarters of declining GDP, that's a recession. By the way, we just had 1 quarter. The first quarter was declining GDP. We may be in a recession right now. We won't know. We got to finish the second quarter. That result won't come out until the end of July at that point. And then kind of see where it goes from there. So we may, but then the National Bureau of Economic Research will make a decision. That might take a year. Like a year after the recession is over, they might say, "Hey, it's a recession." So we won't know for a while, but we could be in a recession right now. A depression is different. Economists hate what I call the D word, the depression word, for a couple of reasons. Number one, it's not quantitatively defined. You can define it, but it's not defined numerically in a way that you can stick into a closed form equation. So that's right off the bat, they don't like it, even though it's a real thing. There are depressions, but they just don't like to talk about them. The other one is I kind of alluded to, is psychological. Gee, if you talk about it, you might actually be in one. Well, that's just denying reality. But a depression, people say, well, gee, if a recession is 2 quarters of declining growth and a depression sounds worse, that must be like 6 quarters or 10 quarters of declining growth. But no, that's not the definition of a depression. Depression means depressed growth relative to potential or relative to trend. So the post-1980 trend, all recoveries, is actually 4%. And if you go back to World War II, post-World War II recoveries, that trend is more like 4.5%. But if you're actually growing at 2%, you're growing, but that's depressed. In other words, if 4% is the norm and you're growing at 2%, there's a gap there. It's a wealth gap, and it gets bigger over time, by the way. So a depression is depressed growth. It's growth below trend or below potential. You still have growth, but it's a bad thing because you're leaving trillions of dollars on the table. If you could just get back to trend or just get back to potential, you would make trillions of dollars more in your economy, which means greater wealth for everybody. So depressions are real. They're serious. They can last for a long time. They can include recessions. So, for example, the Great Depression, 1929 to 1940. Okay, there were two technical recessions in the Great Depression. One was 1929 to 1933. The other one was 1937, 1938. Between 1933 and 1936, the economy grew fairly well, and the stock market went up in the middle of the Great Depression. But the problem was you were so far in a hole, you're still climbing out of the hole. If you have 25% unemployment, which we did, and you get it down to 15%, well, nice going. That's pretty good growth. But it's still 15%. It's like if I fall into a 100-foot hole and I climb out 50 feet, I'm a pretty good climber, but I'm still 50 feet below where I started. And so that's what I mean by depression, below potential growth, below trend growth for a persistent period of time, occasional technical recessions, and we may be in one right now. But basically what it means is you can't, you risk not being able to roll over the national debt. The national debt grows and it makes growth potential even worse. People can't find jobs. There are a lot of other collateral consequences from it. Lost skills, people permanently drop out of the labor force. So depressions are bad, they're serious, but they're not well understood because economists don't like to talk about them.
I see all these people out on the street and they're like begging for money, and I'm thinking, wow, there's all these jobs supposedly. You're saying all the jobs are going to go bye-bye. They're going to go away.
Well, yes and no. And when you get deeper into a technical recession, yes, unemployment will go up and some jobs will disappear. But what's missing from that, and you're right, Greg, about, I travel quite a bit, COVID or no COVID. I mean, I get around the country and, they're driving, flying, whatever. So I see the same thing. But what's missing is that, so unemployment right now, I forget the exact number, it's around 3.5%. It might be 3.4%. It's extremely low as measured by the Labor Department. It's the lowest since at least the 1960s, maybe going back even further. And of course, the Biden administration talks about tonight, we have the lowest unemployment since, whatever, John Kennedy or however far back you want to go. That number is low. But if you have left the labor force, you're not counted as unemployed. In other words, that's a fraction. It's the number of people of jobs divided by the labor force. but the labor force itself is a defined term. If you're not working, you have to be looking for a job, doing interviews or answering one ads or showing up at the labor office or whatever it might be, to be counted among the unemployed. But there are, and estimates vary, but perhaps 10 million or more Americans between the ages of 25 and 54. I'm not talking about 70-year-olds who still want to go to work, and that's fine. I'm not talking about 19-year-old college students. I'm talking about people between the ages of 25 and 54, prime working age, who are not in the labor force. They're not looking for jobs. Now, there are always legitimate reasons for that. You could be a homemaker. You could be a student, maybe an early retiree. So you never get to 100% labor force participation. But labor force participation since around 2000 has declined from close to 70%. Today it's around 63%. Now, there was a big boom beginning in the 70s as women entered the workforce and previously not counted as unemployed, but now they're looking for jobs and they got jobs. So that was a massive expansion of the labor force and added to a lot of productivity in the 80s and 90s. But that's over. Now it's going the other way and people are dropping out. So my point is, if you took that group I described who are not, they could have jobs, but they're not in the labor force, they're not looking for jobs, and added them to the denominator of the fraction, the numerator, unemployment would actually be more like 10 or 12%, which is recession or even depression level unemployment. So I don't put much stock in that low unemployment rate, the 3.5%, maybe 3.4, whatever it is, because it doesn't count 10 million or more Americans who could be working and are not even looking for jobs. You put that group in the mix, the unemployment rate would go way up. So again, I don't buy the happy talk from the White House, because they're ignoring a huge, potentially productive cohort of Americans who basically given up. They're kind of on the couch, eating Doritos and watching NBA playoffs or whatever it may be. I'm not disparaging anyone. I'm just saying it's a reality, and you have to include those people if you want to see what unemployment really is.
Are the markets going to tank? I mean, you've seen all the run into the markets with almost seemingly on bad news. Are the markets going to tank in your estimation?
Well, the answer is yes. Let's define tank. So right now we're in a bear market. A bear market can be prolonged. And bear markets are funny because there are all these rallies. I mean, just the other day there was I'm looking at the Dow Jones, I think it was a 400-point rally, and everyone goes, oh, see, happy days are here again. And then the next day it was down 600 points. So net down, but with a big day in between. I don't hold myself as a technician. I'm a macro analyst, and I look at fundamentals, I look at other factors, but I'm basically a global macro analyst. But I do look at charts and I pay attention to them, even though I'm not, I don't, again, hold myself out as a great technician. But if you get away from the day to day, the stocks go up, the stocks go down, and people have the attention span of insects. They just don't really have long attention spans, it's another story, but it's unfortunate. But if you look at a 1-year chart of any of the major stock market indices, let's just take the Dow Jones because most people follow it. It has what's called a head and shoulders pattern. So head and shoulders pattern is it gets to an all-time high, it goes down, okay. It goes up to a new all-time high, and then it goes down again, and then it comes up again, and people are expecting a third all-time high in a row, but it doesn't. It doesn't get that far, and then it starts to go down. So you have the head in the middle, and you have these two shoulders on the side, peak, bigger peak, and then another peak. So it just kind of looks like a head and shoulders. But what that signifies is if the third rally couldn't surpass the second rally, you're now in a downtrend, and that consists of what are called lower highs and lower lows. So yeah, you'll have rallies, you'll have big up days, but you'll never get back to that last peak. And then you'll have down days and down weeks, and you'll go lower than the previous low. So the trend is lower, even though you have these big days. So those big days are called bear traps or bear rallies or whatever. But they kind of fool people into thinking that the market's still strong when it isn't. But if you, again, step back, look at the bigger picture, you'll see we're in a downtrend. So that's a bear market. They can go on, I remember 1969 to 1982, it's at 13 years. And yeah, there were rallies along the way, but there were awful there were three recessions in that period, 1974, 1980, and 1981. And there were awful dips, but there were some rallies too. But the overall trend was kind of, actually it was down at times, but ended up flat. What was interesting about 1969 and 1982 is you ended up where you started. The market didn't go anywhere for 13 years.
Wow.
So, but it included bear markets along the way. So we're in a bear market now. It can last a really long time, and that's really the point. Now, a crash is different. A crash is when you just, you open a trap door and it goes straight down, 20%, 30%. They happen more often than you think. It happened in March 2020 during the height of the COVID panic. The market was down 30%. Certainly happened in 2008. Happened again in 2020. In 2001, the NASDAQ crashed 80%. Took 15 years to recover. Everyone's like, hey, NASDAQ's at an all-time high. Well, yeah, it has been recently. It's off the top, but not that long ago it was at an all-time high. But they forget that it crashed 80% in the dot-com bubble and took 15 years to come back. So that's what a crash looks like. That's what a bear market looks like. So
you think
do I expect a crash? I would say yes, because
wow.
Yeah, I think we are, and maybe later this year. And let me, if I can, Greg, I'll give you some very specific analysis behind that, because I don't like to make claims without kind of backing it up. We've seen this movie before, beginning in 2013, and I'll be succinct. 2013, interest rates were zero, and we had quantitative easing under Bernanke. And Bernanke said, we're going to taper. He didn't use the word taper, but basically reduce long-term asset purchases is the phrase he uses, meaning we're still going to print money, but we're going to print it at a slower pace. And everyone said, well, that's not tightening because you're still printing money. Well, it is tightening, because when you do anything at a slower pace than you did before, you're reversing course. So that is a form of tightening. That was enough to send emerging markets into a tailspin. And then it was going to start the taper in September 2013, chickened out. They actually started in November 2013. It lasted a year. So by November 2014, the taper was done. Now, they still hadn't raised rates, but they did reduce asset purchases to zero. So there was no new money printing. Then a year later, December 2015, Yellen raises rates. Took another year for the second rate hike. That was December 2016. Then Powell comes in, and then they started like clockwork, 25 basis points, 8 times a year, boom, 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 boom. Got it up to about 2%, got rates off of zero up to about 2% by September 2018. What happened next? The market collapsed. Between October 1st and December 24th, 2018, what I call the Christmas Eve massacre, the market fell 20%. And in fact, the Fed kept tightening into that weakness. The Fed tightened. They did their last interest rate hike in December 2018, even after the market was down about 15% at that point. And then Christmas Eve, December 2018, the market fell 3% in one day. And at that point, Powell got spooked. And then first week of 2019, he comes out and says, that's it, no more rate hikes. And then about a couple months later, he says, by the way, we think we're going to cut. And then they did. And then they said, on top of that, we're going to do some more QE. I forget if that was QE6 or QE7. Depends how you count. Then, of course, 2020, here comes COVID. And where are we by April 2020? Interest rates are back down to zero. And the Fed's balance sheet was expanded to $7 trillion. So in other words, not only did the Fed fail to normalize is when you get rates around 2.5, 3, and you get the balance sheet down to maybe 3 trillion. That would kind of look normal. The Fed failed to do that. They trashed the stock market in the fourth quarter of 2018, reversed course, and got all the way back down to zero, and expanded the balance sheet to $7 trillion and did more QE. So not only that was a failure and a complete reversal course, but they ended up worse than where they started in 2013. So 2013 to 2020, 7 years. And they ended up back where they started in terms of rates at zero, and worse than when they started in terms of balance sheet, which was 7 trillion. So that shows two things. Number one, the Fed completely failed. And number two, they did trash the stock market down 20% in 3 months and got very close to doing worse. Now they're trying to do the exact same thing. What are they
Huh.
doing? Well, March they raised rates. In May they've already told us they're going to raise 50 basis points. June 50 more basis points, 25 basis points probably in July, September, November, and the other meetings throughout the end of the year. And they've completed the taper, so they're not printing any more money. And probably in May they're going to announce more quantitative tightening, which means you actually reduce the money supply. So this is triple tightening, big interest rate hikes, no more taper, obviously, doing quantitative tightening at a very rapid rate. So what just happened? We had a down quarter. The economy was at recession levels in the first quarter, and the stock market's on the way down. So here we go again. The Fed is tightening into weakness, tightening into economic weakness, tightening into what was certainly a stock market bubble. They'll probably destroy the markets again. Now, except with one big difference. The last time it took 7 years to do the round trip, and it took 5 years to trash the market. But the market kind of wised up. They've seen this movie. They know the Fed can't do this without causing recession and trashing the stock market. So they're not going to wait 5 years this time. This is going to probably come to a head, I would say late this year, early next year. But yeah, you'll see a short stretch when the market drops 20% or more, maybe 30%. I would call that a crash. On top of a bear market, on top of a recession, only then will the Fed wake up and say, maybe we ought to stop cutting rates. But it'll be too late by then.
When you say too late, it'll be the markets will be damaged pretty bad.
Correct. The Fed's always the last to know. Like I know, we just told our viewers what's going to happen. There are a handful of other analysts who know. You don't have to have a crystal ball. You just have to know how markets work and how dynamic systems work. And again, learn from history because the Fed already did this. So eventually people will catch on. The market will catch on. People will bail out. They'll go to cash. And the Fed will be the last to know. And it's not because they're dumb. They have the IQ points. But they have badly flawed models. And one of the long list of them I could name, the wealth effect and inflationary expectations and others. But one of the really bad models for this point is the Phillips curve. And the Phillips curve assumes that there's a reciprocal relationship between unemployment and inflation. So in other words, if unemployment's really low, then inflation has to go up. And so the Fed has to raise rates to kill inflation. And then when inflation comes down, maybe unemployment goes up because at that point you're in a recession. There's no empirical evidence for that. I mean, it happens sometimes, but the opposite happens. Sometimes you have, in the 1970s, we had high inflation and high unemployment. In the 2010s, we had low inflation and low unemployment. So there is no correlation, but they think there is. And they're completely ignoring what we talked about earlier, which is the unemployment rate doesn't say anything about unemployment because you're not counting all the unemployed people who aren't counted. In other words, they're out of the labor force. When you think of that as potential slack, people who could come into the labor force if you paid a high enough wage, and maybe employers would get to that, then you realize the danger of inflation from that side, from the demand side, is not that great. Now, there is inflation. There's no denying it. But the inflation that we're seeing right now, and it is the worst in 40 years. I mean, you can't argue about it. It's there. You can argue about whether it'll last or not, but there's no denying that the inflation is front and center. But the inflation we're seeing now does not come from the demand side. It does not come from consumers. It does not come from high inflationary expectations. It's from the supply side. It's because of the war in Ukraine, supply side disruption, the zero COVID policy in China, locking down two of the biggest cities in the world. Beijing has 22 million people. Shanghai has 26 million people. And Beijing, the Communist Party of China, locked down both cities because a relatively small number of people had COVID. And they've got this stupid, idiotic zero COVID policy. You might as well say zero colds. We're going to have a policy that says if anybody gets a cold, we're going to lock down, one of the biggest cities in the world. You can't stop COVID. The virus goes where it wants. The one thing that does stop it, that turns it from a pandemic to something you can kind of live with, is herd immunity. In other words, if enough people get it, forget the vaccines. The vaccines don't stop you from getting it. They don't stop the spread. They do reduce severe symptoms in some cases, but that's a very different thing from saying it prevents you from getting it, because it doesn't. I mean, there were 5 million Americans who got the Omicron virus in late 2021 who were double vaxxed and boosted. So there's your proof. We knew this doesn't work. We knew it 2 years ago, but when it first came out. But even for the doubters, the vaccine brigade, whatever you want to call them, there was overwhelming empirical evidence that the vaccine does not stop you from getting COVID. And you actually don't hear much about it now because all the big mouths in Washington got it, and they all got COVID, and they were all double vaxxed. But my point is, the way you do get through it is with herd immunity. The vaccine is getting COVID. You get COVID, and the fatality rate is very low, and there are treatments. But if you get it and come through it, which with a mild case, which is true in almost every case, the natural antibodies you get from having COVID are the vaccine. Getting the disease is the vaccine. You're much less likely to get it twice. China never did that because China was their vaccines really weren't very good, but because they were so fanatical about squashing it in every instance, they never got to herd immunity. They're still not there, and they're not going to get there if they keep up this idiotic policy. But there's a political aspect to it. The 20th National Congress, which is a big deal in China, is in November. That Congress will ratify Xi Jinping as the new Mao Zedong, the dictator for life, in effect. They've had a tradition, goes back about 25 years, but for China that's a long time, where the leader does a term and then does a second term. He's a 5-year term. So you do 2 5-year terms. You get to be leader for 10 years. But in your second term, you announce your pick to replace you at the end of the 5 years. So you already know in advance who the new guy is going to be. And it's just very smooth and consensus driven, and the leader operates by consensus. We saw this through Jiang Zemin and Hu Jintao, and started down this road with Xi Jinping, except he decided to break the mold. And he's at the end of his second 5-year term. He should step aside in November and have a new guy come in, but he's not. So this 20th Party Congress, or National Party Congress I referred to, is where he's going to be made dictator for life. Well, between now and then, between here we are in the spring of 2022 and November, he doesn't want to rock the boat. He doesn't want any trouble. And so they're going to do this stupid policy, and it is stupid, as if they're doing something smart, but they're going to make it worse. But as far as the United States is concerned, getting back to our discussion about the Feds screwing up the economy, which they will, what's going on in China greatly disrupts supply chains, increased costs, reduces global output, and makes things in the United States more expensive, messes up the transportation lanes. Don't forget, it's not just inputs and manufacturing. You got to put things on vessels and move them across the Pacific Ocean. Well, they're backed up like crazy. They were backed up at the port of Los Angeles trying to unload. Now they're backed up in Ningbo, which is the port near Shanghai, and elsewhere, waiting to load. But they can't because the place is locked down. So, and then don't get me started on the war in Ukraine. That's another whole fiasco. But we got multiple, between the COVID lockdowns in China, the war in Ukraine, the elimination of Russian and Ukrainian exports, the scrambling of supply chains, hangover effects from the trade war that Trump started in 2018, plus lack of consumer demand because the necessities are doubling and tripling in price. By the time you get done paying for gas and groceries, if you can, there's not much left over to take your spouse out for dinner or go to a movie or shop on Amazon. So that's going to kill discretionary spending. That feeds into the stock market. It's a pretty bad concoction we've cooked up here.
I do want to talk about Ukraine, and the only reason why, just a short thing, and I can't believe he admitted to this. Secretary of Defense Lloyd Austin, they want this $33 billion out of Congress to send it to Ukraine. So this last week, Lloyd Austin, in his idiocy, moronic state, said the goal was to stretch out the war. They don't want to win it. They don't want to have peace. They want to stretch it out and create a quagmire for Russia. Wow. What could go wrong? This is the idiots running the Pentagon. I can't believe he admitted he wants to stretch out the war and create a quagmire for a country with hypersonic nuclear missiles. Your turn.
Well, yeah, the expression is, I'm sure you've heard it, but I think it's true, where the United States is willing to fight to the last Ukrainian. Um, and a couple of things. First of all, there was never, this is a real tragedy, Greg. There was never a war that was easier to prevent. This war did not have to happen. All that had to happen was, Biden, I don't know if he's capable of talking on the phone, but somebody in some authority could have called Zelensky and said, look, you need to say, we'll put it in writing, we'll sign it and assure Russia, Ukraine will not join NATO, and Ukraine will remain neutral as between East and West. If you do, and we'll give, Luhansk and Donetsk some autonomy, not to peel them off, but they get autonomy. Ukraine's neutral and Ukraine will not join NATO. If you say those three things, Putin won't invade. And that was easy to do because that's where it's going to end up. The real tragedy is it's going to end up where I just said, but you could have skipped the war, right? And even now, after 3 months of war, you could end the war in 48 hours. If I were authorized by the White House, I could end the war in 48 hours. All you have to do is say the same three things. Not joining NATO, we're going to remain neutral, with one difference, which is at this point, Donetsk and Luhansk are not going to be autonomous. They're going to be stripped out. I mean, Putin didn't want the war, but he got it. He started it after being provoked for 8 years by the United States, or even longer. So having fought this hard, he's not going to give up his territorial gains. Obviously, they keep Crimea, but they're going to keep Luhansk and Donetsk, keep Mariupol, keep the land bridge to Crimea, maybe take Odessa. They're not going to fight for that and give it back. So you're going to end up worse off in two respects. Number one, you're going to get the same deal you could have had with no war, except now you're going to lose territory because Russia already took it. And plus, of course, the tragedy of all the military and civilian casualties. So Zelensky's an oligarch. He's a dictator. He's this stuff that he's the new Churchill. That's nonsense. I mean, he's, as between Russia and Ukraine, it's like pick your dictator. Putin's a kind of dictator, but so is Zelensky. And it's a regional war between, a great power and a buffer state. I don't know what the United States is doing in it, but you're right. Now let's go back to Lloyd Austin's comment. He said two things. Now, he said what you recited, Greg, and you're absolutely right that we're going to just hang in there and wear the Russians out. Of course, Americans dying, fortunately, but Ukrainians are dying left and right. But the U.S. has given them the missiles, the Stinger missiles, the Javelin missiles, a lot of intelligence, satellite surveillance, and a lot else besides. The Poles are kicking in. They're still talking about giving them those old MiG fighters. The Germans are kicking in tanks. Something about German tanks heading east has never been a good sign.
Yeah, that didn't work out well last time.
Just to kind of keep, exactly. Just to keep the whole thing going. But Austin said something else. He said, and we want to wear them out to get closer to regime change. And I don't think he used the word regime change. I don't put words in his mouth, but that was the implication, that the more they're drained, the more casualties they suffer, the more they spend, the more their economy is strangled by sanctions, the more likely Putin will get kicked out. And that's the secret to the whole thing. This is only kind of about Ukraine. This is really about getting rid of Putin. These people, and we know who they are. It's George Kent, Fiona Hill, Susan Rice, Obama, Biden. I can't attribute anything to him because he's non-compos mentis, but Tony Blinken, Jake Sullivan, and a lot of others beside, they hate Putin the way a lot of people hated Trump. It's just irrational, and they have since the late 90s, when people first heard of him coming out of St. Petersburg, because they had all these fantasies in the 90s that the Russians will be just like us. They'll have a stock exchange, they'll have freedom of the press, they'll you go to Moscow, it'll be like Times Square, just like us. Putin came along and demolished all that. He did it for a good reason, which was Russia was actually failing, and all those fantasies about people then in their 30s or late 20s, today in their 50s, who were running the show, just got it in their heads that somehow Putin disrupted their little fantasy, when in reality what he did was consolidate power and put Russia on a more firm foundation. Russia's not a Western country. I've been in Moscow. I talked to Russian experts, like real Russians, and they tell me, they laugh. They say, Jim, the problem with Americans is you think we're just like you. and we're not. I mean, like racially, they kind of, they're like white, whatever. They're not Chinese or Africans. And not that makes that much of a difference. But they say we look like you, but we're not like you. They're Orthodox, not Western, not Catholic or Western style Christians. They're Slavic peoples, with a heavy dose of Asian mixed in. They're not Western Europeans. They have a different culture, everything's different. Everything's different, and religion being a big part of it. It's a different civilization. So if you don't want to take the time to study the civilization, like forget your fantasies. But as a result, they still want to get rid of the guy, and it's costing a lot of lives. Now it will fail. Putin's popularity is higher than ever. The sanctions have failed. I just about 2 weeks ago, I do an annual seminar at the U.S. Army War College on financial warfare. They don't need any help from me on Stinger missiles, but money is a weapon. Stocks, bonds, commodities are weapons. This goes all the way back to 2009 when I did the first financial war game for the Pentagon, which I talked about in my book Currency Wars, my first book, which came out in 2011. So I lead a seminar, and these are mid-career officers. They're lieutenant from all branches, even though it's the U.S. Army War College. We had Army, Navy, Marines, Air Force, and the State Department in the room. Small group, about 12, all handpicked. They're lieutenant colonels, full colonels. We had a Navy commander, again, a senior State Department official. There were just 12 of them. These are the future. They've been singled out as the future leaders and policymakers. And they do a lot else besides in this course. But one of the modules is the one I teach in financial warfare. It was just interesting. They're really smart. I always say you should aspire to be the dumbest guy in the room, and I occasionally achieve that. But that's a good thing. It means you're surrounded by smart people. And these people are really, really quite brilliant. But they're not in charge. They're not four-star generals. They're not national security advisors. Hopefully, they will be in the future. But when I look at the leadership, man, at the White House and the top of the Pentagon, these people are so misguided. But what that means is that this war is going to go on a lot longer than people expect. Our financial sanctions are an utter failure. I just checked that I have trading screens and tickers and all that stuff. The ruble. The U.S. dollar ruble exchange rate today shows the ruble is stronger than before the war began. So how exactly did our sanctions hurt the ruble when the ruble is stronger? The Central Bank of Russia is cutting interest rates. We're raising them. Putin has made tens of billions of dollars because the price of oils went up. Oil and natural gas went up. Now maybe the quantities went down a little, but the price went up so much that the price increase more than offsets the quantity declines. So his total revenues are higher. So he's got more money, a stronger currency. They're cutting interest rates. China's willing to buy all the oil. If Western Europe doesn't want it, they'll say no problem. They got China and India are lining up to buy it. And he's now using natural gas as a weapon, cut off natural gas to Poland. The Poland said, well, no problem. We have a 75-day supply. Okay, see you in 75 days, see how you're doing then. You people are going to freeze in the dark, potentially. And there's a lot else besides it. So the U.S., we crush the oligarchs. We put the oligarchs on the list. Here are their names. You, meaning UK, Europe, Australia, Canada, U.S., all the allies. You can seize their assets, seize their yachts, take their townhouses in Belgravia, take their ownership of sports clubs, freeze their bank accounts, on and on and on. We got you, They're idiot. What the Americans don't realize is that Putin hates the oligarchs. He's like, thank you. Thank you very much for doing this, because he hates the oligarchs. He always has. They're a competing power center. Now, he didn't think he could destroy them because they might push back in certain ways. And what he told them like 8-9 years ago, or maybe a little bit longer, when he put that the head of Yukos in jail for some trumped up tax charges or whatever. But they just made an example of that one guy as a message to the rest. And he said to them, you can have your money. I'm not going to take it. Have your yachts, but don't get involved in politics. Don't mess with me in politics. And they got the message. So they're very wealthy, multi-billionaires, but they didn't mess in politics. But he still hated them and still wanted to get rid of them. Now the U.S. is doing that for him. The yachts are actually being seized. The Belgravia townhouses are being seized. The bank accounts are being frozen. And Putin's sitting there saying, thanks. You know, it's what I always wanted. You guys are doing my dirty work for me, and I'm not getting the blame. And by the way, guess what the oligarchs are doing? They're sending the wealth back to Russia. Remember, they got it out of Russia to London and Singapore and Geneva and New York, Toronto, Sydney, wherever. They got it out of Russia because they were afraid of Putin. But now they're like, you're right. Everyone else is out to get us. So they're sending some of it to Dubai, but they're sending it back to Russia. So you actually have capital inflows. Again, far from starting a panic in Russian capital markets, the oligarchs are bringing the money back because they think that's the only safe place now. So we're crushing Putin's enemies. He's saying thank you. They're sending the money back to Russia. He's saying thank you. Everything we're doing is boomeranging on us. Our commodity prices are going up. Our inflation is getting worse. You know, Poland's going to be out of natural gas. The price of oil went up, so Putin's enriched. We're crushing the oligarchs, so Putin's happy. Everything we're doing is either helping Putin or hurting us. What kind of sanctions are those?
You wrote a book on gold, yet another one of your bestsellers. Where's gold going? Putin is now saying overtly, going to back the ruble with gold, commodities, oil, nat gas, steel, grain. Going to back it all with commodities. Where is gold going? You wrote a book on it, a good one. Your estimation of where gold is going, would you be a buyer?
Yes, and I spent a lot of time on this. I talked about this seminar I led at the U.S. Army War College. Spent quite a bit of time on this. I had a certain slide describing, you know, it was a spectrum, a color spectrum from, you know, ultraviolet to infrared, showing how economic warfare goes from normal competition to kind of cheating, dumping, sanctions, extreme sanctions, and then, you know, cyber warfare. So how you can slide from one to the other and not know exactly where you are because it's not crisply delineated. It's just you're going down a spectrum, and it's okay, but just be careful you know what you're doing because you could end up in the hot end before you know it. And I used to tell the class, this is my most important slide. It was an original concept. I think it was the first one to present this way. And this time I got to that slide and said, this used to be the most important, but this is the second most important. And then I later on, just as a tease, then I got to the most important one. It was exactly what you're talking about, Greg. So imagine a triangle, and it has 3 points, you know, like a triangle has. And one is the ruble, and one is gold, and one is the dollar. And the line between any two is the cross rate between those two. So Putin, actually, Elvira Nabiullina, who's the head of the Central Bank of Russia, I like to say she's the only central bank in the world who really knows her job. So they pegged the ruble gold leg of that at 5,000 rubles per gram of gold. Now you got to do the math. There are 31.1 grams to a troy ounce, since that's 155,000 rubles per ounce. And then you got to ask yourself, oh, okay, what's the price of gold? It's usually measured in dollars. And when they did this, it was around $1,940 an ounce. It's up and down. I don't know where it is as we speak, but it's in that range. So now you've got 2 legs of the triangle peg. The gold ruble thing is pegged at 155,000 rubles per ounce. And the dollar gold leg is what it is according to the market. So at the time it was, I think, 1945 per ounce. So that leaves the third leg. So the third leg is dictated by the first 2 because of arbitrage. Because if it temporarily isn't, if any one of those legs is out of alignment, there's an arbitrage opportunity. Something's cheap and something's rich. So you go in, you buy the cheap one, you sell the rich one, you close it out, and when the spreads converge, and you make free money. Practically, it's a little risk, but a lot less risky than a lot of other things. So if you know the dollar price of gold from the market and gold ruble is fixed, then ruble dollar has to be fixed. And with the math that I just described, guess what the fix is? 80 to 1. In other words, the 5,000 rubles per gram wasn't pulled out of a hat. It was calculated using the market price of gold and a simple transitive law to get to 80 rubles to the dollar, which is where the ruble was when the war started. So what they were doing, it was kind of about gold, but it was really using gold as an anchor to prop up the ruble at 80 to 1 to defend it. Now, so it was basically a ruble bailout mechanism, if you want to think of it that way. And the arbitrage is a little inefficient because not everybody can go to the central bank and sell their rubles for gold, but West German natural gas suppliers can, or natural gas buyers can. But take that a step further and say, well, what happens if the price of gold goes to $2,000 an ounce? Well, now, using the same triangle and the same math, the first leg, if you stick with the 5,000 rubles per gram, and now you say the price of gold is $2,000 an ounce, you go to the third leg, guess what happens? Now the ruble exchange rate is like 78 to 1. In other words, a higher dollar gold price means a stronger ruble.
Oh.
And so now, not only are you putting a floor under the ruble, but you're creating a situation where if because of inflation in the U.S., or the U.S. decides to buy gold, or the world decides to buy gold because they don't trust the dollar, or everyday people buy gold because of inflation, but in any one of those scenarios, the price of gold goes up, the ruble gets stronger, not weaker, stronger. So it started out as a lifeline, but it's become an aircraft carrier. It's become something that is going to strengthen the ruble. And it's put everyone else in a box. It's like, you want to buy gold? I think it's a good idea, by the way. But if you want to buy gold, you're making the ruble stronger. So this is, Putin has his hobby is he's an excellent piano player, but he has two sports, which are martial arts and chess. And he's showing, I don't know what his chess ranking is, pretty high, but he's showing his skill as a chess player. And I happen to be befriend Garry Kasparov, who's one of the greatest chess players of all time, and I've spoken to him about it a number of times. And Garry couldn't, no human could think 4 moves ahead. It's like mathematically impossible. I mean, you can do it on a computer, but it's kind of hard to do in your head. 3 moves ahead, a grandmaster like Garry could kind of do 3 moves ahead, but boy, is that hard. 2 moves ahead, you got to be really smart. And the average chess player is 1 move ahead, meaning if I do this, you're going to do that, and then what am I going to do next? That's kind of 1 to 2 moves ahead. It'd be nice if the United States could think 1 move ahead. I don't think we've shown much capacity to do that. But my point is, Putin and Elvira Nabiullina are showing off their chess playing skills because they didn't just put a floor under the ruble. They basically dared the world not to buy gold, because if you do, you're going to make the ruble stronger and the dollar weaker. That's what a higher dollar price for gold means. So now we're set up where, and the U.S. has done this to ourselves. I've said the world could never destroy the dollar, but the U.S. could do it. We could do it to ourselves, and that's what we've done. And this Wally Adeyemo, he's the Deputy Secretary of the Treasury. He's the sanctions king. I don't think he's ever had. He carried Larry Fink's briefcase for about a year, but other than that, he's never had a real job. He was, I think, a assistant national security advisor, and then he was president of the Obama Foundation, and now he's Deputy Secretary of the Treasury. Smart guy. I don't doubt his IQ points, but if you're not out in the real world, if you're not working on Wall Street, you don't know you don't understand the plumbing, you don't know how the game is played, you don't know how capital markets actually work behind the curtain, which is what we're talking about. So now we talked about how these sanctions boomerang, but if you're putting sanctions on dollars, if you're freezing dollar accounts and seizing dollars and kicking people out of the dollar system, why do I want dollars?
Well,
why would you want dollars if the U.S. just freezes them? And it's like, well, it's only Russia. Well, Russia today, it could be China tomorrow, it could be somebody else. So the whole world, I'm talking about the Arabs, the Swiss, the Chinese, maybe even the Japanese, the Russians certainly, and others are saying, maybe I better back away from this dollar system and get something else, because the U.S. has destroyed trust, basically. They've shown that they're willing to weaponize the dollar. Maybe I'm the next target. So now you say, well, okay, if I want something else, what is it? Well, The ruple's not going to be a global reserve currency. Yeah, okay, it's now a payment currency, an enhanced one because of the gold connection, but it doesn't have a long list of things you need to be a reserve currency, which is basically a bond market, liquid bond market and good rule of law. They don't have that. Neither does China, neither does India, Brazil. Europe barely has it because there's no. You have a German bond market, but it's not that big. So there isn't a currency that can really fill the bill. So even if you want to get away from dollars, there's not a currency or bond market you can really go to, but there is gold. Gold is money good, always has been. And I'm not a gold salesman. People go, oh, you're just talking your business. No, I don't care. I do what I do what you want. I'm not here to sell anybody some gold, but I'm telling you that gold is the only form of money that the whole world could agree on. If you want to get away from the dollar, there's nowhere else to go because nothing else, is suitable. So that's going to drive the price of gold higher. It's a long-winded answer to your question, Greg, but gold's going to go a lot higher. Now, if you take it a step further and get into a world where, okay, not only is gold a reserve asset, but we're going to go to something kind of looks like a gold standard, maybe in stages, not all at once. What does the dollar price of gold have to be to support commerce, to support all the payments and all the trade and all the investment and all the, as I said, the payments and capital flows in the world? What would it have to be? Well, I've done that math, and the answer at the low end is $15,000 an ounce. I used to say 10, but that was true 7, 8 years ago when I started. But it's a simple equation. But money supply is one of the inputs into the equation. So as the money supply increases, which it has, the dollar price of gold has to be higher to work. So it's not like I just made up a new number. It's like, well, you change the inputs, the output's going to change. So today would be closer to $15,000 an ounce. At the low end, now you can change some assumptions, use M2 instead of M1, use 100% backing instead of 40% backing. You get to $40,000 an ounce real fast. But and I've seen other analysts kind of reach the same conclusion recently. So $15,000 an ounce, give or take, is a realistic level for something that looks like a gold standard that's non-deflationary. Now you can have a lower dollar price for gold, but if you do, you're going to have to lower the money supply to make it work, and that's going to be deflationary, and nobody wants that. So that's where gold's going. But in the short run, yeah, it's going to go. I always tell people it's got to get to 3,000 before it gets to 5,000. So you can pencil in $3,000 an ounce in the not distant future.
Wow, you think this year? You think this year 3,000 an ounce?
Well, let's see. Not possibly. Yeah, possibly. If you get the kind of stock market crash that I wouldn't rule out. But no, look, it's going to blow past 2,000. But the other thing that people don't. Well, I mean, you can understand it's not that difficult. But as you get to higher levels, each dollar increment represents a smaller percentage gain because you're working off a higher base. So let me just give a simple example. If you go from $2,000 to $3,000 an ounce, that's a 50% increase. That's a big jump. But if you go from $7,000 to $8,000 an ounce, that's only a 14% increase. Now it's the same $1,000. If you got the gold, you made the same $1,000, either going from 2 to 3 or 7 to 8. But it's much easier to do it from the higher levels because the percentage gain is smaller, just because the denominator of the fraction is smaller. It's just, fifth grade math. So, but people don't get it. They tend to look at the round numbers and think of $1,000 increments. So what happens is, it's a long haul from 2 to 3, but then you go to 3 to 4. That's only a 33% increase. 4 to 5 is only a 25% increase. 5 to 6 is only a 20% increase, et cetera. Each gap gets easier than the one before, and then it just takes off because now you've completely changed the psychology.
Wow. And last question, just for common folks. What would you tell common folks to do without a lot of money? Buy silver, buy food. I say this all the time. Get new tires. Get a new battery. What would you tell common people to brace themselves for what's coming? Obviously, higher inflation.
First of all, silver is a good hedge. It's I recommend something called a monster box, and it comes straight from the U.S. Mint. Of course, the mint is controlled by the U.S. Treasury, so it's Treasury green. It's a nice sort of unique shade of dark green. I call it, well, everyone calls it Treasury green. It comes with a compression strap. I say don't cut the strap because if you ever want to sell it, it's nice if it's like not opening a can of sardines, keep it sealed. But inside are 500 1-ounce American silver eagles. Those are pure silver coins, brand new from the U.S. Mint, and 500 ounces. So, with commission, that's going to run you around probably $14,000 a box, but that's a lot of silver. 500 ounces is a lot of silver. And I tell people, remember, when the power grid goes down, the ATMs are closed. It's not because there's a run on the banks, because they run on electricity. So your Bitcoin's worthless because there's no electricity. Your ATMs don't work. Gas pumps don't work. Credit cards don't work. And you run out of regular cash pretty quickly because most people don't carry that much. But in a real emergency like that, a solid silver coin is money good. That might be what it takes to feed your family, because some seller will say, "Okay, I'll take pure silver, sure. It's been good for thousands of years," and that's affordable. You get into gold is at even $2,000 an ounce. 7 ounces, 8 ounces for $15,000. There's nothing wrong with that, but somehow 500 1-ounce silver coins is it's like a battery and flashlights and hurricane. It'll serve you very well. Food, I do anticipate food shortages. You can see them coming. I think more people will die from starvation as a result of the war in Ukraine than battlefield casualties, including civilians. Why? Because Russia and Ukraine together export or account for 25% of the world's wheat exports, about 30% of the world's barley exports. That's a lot, but if you go country by country, you'll find a lot of countries in the Middle East get 100% of their grain from Ukraine. Lebanon gets 100% of its wheat from Ukraine. A list of countries, Egypt, Somalia, Sudan, Kenya, others get between 50 and 100% of their grain from either Ukraine or Russia. So take those two out of play, which they are. Those people are going to starve, and you're going to have a humanitarian crisis, the likes of which you haven't seen. But that's bad. But then spread that around the world. Russia is one of the leading exporters of fertilizers. This is the planting season. We're in the spring. I mean, a little bit past the planting season. Farmers all over the world are saying, I can't get fertilizer. I can't plant because I can't get fertilizer. If I do get it, the price has doubled or tripled. So my output's going to be a lot higher. I'm going to double or triple the price because I had to double or triple the inputs. So at best, you're going to see much, much higher food prices, continuation of the inflation. Intermediate case, there are going to be shortages. In worst case, you're going to see starvation. So I would maybe buy a freezer, and load up on chicken and ground beef and steaks and frozen meatballs while you can, and frozen vegetables, because that might serve you well. And pay attention. You got to be nimble.